1 million young people in Britain are not working, not studying, and not in training. That figure is not a projection. The Office for National Statistics confirmed it for the first quarter of 2026, published Thursday, the same morning that former Health Secretary Alan Milburn delivered his independent review of youth unemployment to the Labour government. The session opened with gilt markets already absorbing a busy week of UK data, and the Milburn review added a structural dimension to what traders have been pricing a labour story. The FTSE 100 held broadly steady, with consumer-facing stocks, retailers, hospitality, and leisure under the most visible pressure as the cumulative cost picture for UK employers came back into focus. The Employment Hero platform published separate data on the same day, showing that employment costs for full-time staff had risen 9.6% over the past year, and that 78% of UK firms said the changes in employment law had affected their ability to grow. The Employment Rights Act came into force on 5 April 2026, less than 2 months ago, and smaller businesses are already reporting a sharper deterrent effect than their larger counterparts. Next Chairman Lord Simon Wolfson said directly that Rachel Reeves' tax rises had squeezed entry-level jobs, the very jobs that would absorb the 1 million NEETs if the system were working as intended. Apprenticeship starts among young people have fallen 35% over the past decade, and 1.6 million fewer low- and medium-skilled jobs exist in the UK than in previous decades. The milestone of 1 million, crossed now for the first time, sat over the day's trading like an unresolved balance sheet entry. The number that changes the meaning of everything else in the Milburn review is this one. For every £1 the Department for Work and Pensions spends on employment support for young people, £25 is spent on benefits for young people. That ratio is not the result of a single policy decision or a bad quarter. It is the accumulated shape of a welfare architecture that, according to Milburn, exacerbates inactivity rather than resolves it. The review calls the current system broken, and the spending ratio is the mechanism that explains why the headline figure keeps rising, even as successive governments announce new employment programs. The inversion runs deeper than the ratio itself. 84% of NEETs surveyed said they wanted a job. The demand for work is present. What the review identifies is a supply-side failure. Employers running algorithmic hiring processes that screen out first-time job seekers, requiring past experience for entry-level roles, and in some cases substituting domestic first-time workers with foreign hires. Milburn criticized these practices directly, placing responsibility on the private sector alongside the public sector, a distribution of blame that business groups will contest, given the concurrent 9.6% rise in employment costs imposed on them by government policy. That interpretive contest is already underway, and it matters for positioning because it determines where the eventual fiscal response lands. The capital consequence runs through 2 channels simultaneously. The first is the direct welfare liability. Disability payments for young people currently stand at approximately £3.2 billion, and the Milburn review projects that figure rising to £6.5 billion by 2031, a doubling if current trajectories hold. The second channel is the productivity drag. The review estimates the NEETs crisis cost the UK economy £125 billion a year in lost output, foregone tax receipts, and increased public spending. A liability of that scale does not stay out of the gilt market indefinitely. The 28-year gilt high flagged by the IMF last week has not resolved, and a structural productivity story of this duration and magnitude provides the fundamental underpinning for why long-end gilt yields are finding it difficult to retrace. The participant timing asymmetry here is notable. Fiscal hawks and sovereign bond desks moved first. They have been pricing UK structural underperformance for months. Equity investors in UK consumer-facing sectors have been slower to fully price the entry-level hiring constraint, partly because the Employment Rights Act is so recent, and partly because the headline unemployment rate for the broader workforce has not spiked. The NEETs figure is specifically a youth cohort measure, and it takes longer to transmit into price earnings multiples for retail or hospitality stocks than it does to transmit into gilt risk premium. The Milburn review calls for a universal credit overhaul that allows young people to job search without immediately losing benefits, alongside reforms across education and the NHS, and a fundamental change to employer recruitment practices. If those reforms arrive quickly and at scale, the mechanism that sustains the 25-to-1 spending ratio begins to unwind, and the fiscal drag on gilts from the welfare side diminishes. The verification benchmark for that scenario is the ONS Q2 2026 NEETs figure, due approximately August 2026. A plateau or decline from 1,012,000 would represent early evidence that the review's publication is already shifting hiring behavior or government spending priorities. The OBR's next welfare spending projection update will be the second check. if disability payment forecasts for young people are revised down from the £6.5 billion 2031 trajectory, the fiscal overhang recedes. The breakdown scenario requires less imagination. If the Employment Rights Act continues to suppress entry-level job creation, if the NI burden on employers remains unchanged, and if algorithmic hiring continues to exclude first-time job seekers, the Milburn projection of 1.25 million NEETs within 5 years becomes the operative forecast rather than the warning case. Disability payments doubling to £6.5 billion by 2031 would then be a floor rather than a ceiling. UK 10-year gilt yields would face continued pressure from the fiscal side, compounding the trade and monetary dynamics already in play. Consumer discretionary stocks with heavy UK high street exposure, those most dependent on entry-level labor and most sensitive to domestic consumer confidence among younger cohorts, would remain under relative pressure versus capital-light alternatives. The 1 million figure that opened this morning's session was a milestone in this statistical sense. Whether it proves to be a turning point, the moment the government mobilizes sufficient reform, or simply the first clean number in a series that keeps climbing, will not be visible in today's prices. 1 million young people said they wanted to work. The system spent £25 on keeping them in place for every pound it spent on moving them forward. That arithmetic, and not the headline number, is the variable that gilt traders are now watching. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.